Good evening, everyone. A very warm welcome to all of you, and thank you for taking the time to join us today. For those who may not know me, I'm Pooja, Compliance and Operations Manager at Quinstinct Advisory. I have been with the firm since its inception, and I've had the privilege of being the part of its growth journey. Today's presentation will cover what we felt was most relevant in today's environment, whether the rush for investing abroad will continue to deliver good performance, whether Indian equities will rise again after a 18-month slumber, and whether gold will continue to be a safe haven in 2026. This presentation will last for about 30 minutes, after which we will open the floor for questions. Please feel free to post your questions in the Q&A box during the webinar. Towards the end, we hope to open the floor for a live Q&A. You may raise your hand and we will unmute you so you can ask your questions directly. We hope today's session provides valuable insights as we navigate the evolving landscape together. With that, I'll hand it over to Sunil.
Good evening, everyone. Thank you for joining us today. The investment landscape that we are looking at is that the Nifty index has given a close to negative return over the past almost 1.5 years. At the same time, the US market is at an all-time high, and the opportunities and the threats presented by the AI ecosystem is affecting global investor sentiments. Here, we are looking at how the Indian and US markets have performed over the past 25 years. Starting from the year 2000, Nifty has delivered an annualized return of 18% in the first 10 years, while the S&P 500 actually ended up with a negative return. From 2010 to 2020, S&P 500 delivered close to 12% annualized return, while the Nifty return was only about 3% in dollar terms. In the first 5 years of this decade, S&P 500 has delivered 12.7%, while Nifty has delivered close to 9% annualized return. If we look at the valuations, year 2000 Nifty was at 16 times earnings, while S&P was at 26 times earnings. S&P delivered about 4.5% earnings growth, while Nifty earnings grew at close to 15%. The roles reversed in 2010 when the Nifty start valuation was 20 times compared to 16 times of the S&P, and Nifty earnings actually went down during this decade. S&P had a 2% earnings growth. In 2020, the start valuation for the Nifty was at 32 times, while S&P P ratio was at 40 times. Earnings grew at 16% compared to 20% for S&P. So India started at a low valuation, had higher earnings, and ended up making an 18% return. Whereas US started at a higher valuation and a higher earnings growth. Going back to fundamentals, it is earnings growth and liquidity that sustains valuations over the long term. If we look a bit deeper into the earnings growth over the past 5 years, we see that 2021 was an exceptional year. Earnings rebounded after the COVID pandemic, with the S&P earnings growth in the aggregate being at about 110%. However, the 4 years that followed, the average earnings growth of S&P 500 index was only at 2.2%. with the last 2 years completely dominating by the tech companies. Nifty had an earnings growth of 61% in 2021, and the average earnings growth was 7.2% in the last 4 years. Coming to the second aspect, which is liquidity, we are seeing a scenario where global liquidity is getting tighter with the Japanese bond yields rising. In January this year, a Japanese government bond auction technically failed and the yields jumped up. The 30-year bond yield went beyond 3% and the 40-year bond yield breached 4.2%. This resulted in unwinding of highly leveraged yen carry trade positions, and asset prices, including that of precious metals, fell sharply. While global liquidity seems to be tightening, we have a slightly different scenario in India, with the rupee valuation being extremely low. We are at an all-time low against the US dollar, and in real effective exchange rate terms, the INR is considered undervalued at this point of time, representing a significant correction from the overvaluation seen in late 2024. This is important as a weak currency is supportive for FII inflows. However, when we look at India, the FII inflows will happen only when there is a recovery in our earnings growth. And that is something that we have seen in the last 2 quarters. Our valuation is also at a significant discount to the S&P 500 index. We need to also keep in mind that in the last 2 years, earnings growth for S&P 500 was primarily driven by the tech companies. So we are seeing a scenario where the US valuation is currently being supported by somewhat fragile growth of about 2.2% annualized growth in earnings over the past 4 years. And the liquidity seems to be tightening with the global bond yields pricing, especially the Japanese bond yields rising. Whereas in India, we have a more stable earnings growth, and the liquidity appears to be in a favorable situation with the INR being undervalued. Based on our proprietary market model, Nifty is at a border between 4 and 5, and S&P 500 is currently at a market type 5. Market type 5 represents a hold situation where we stick to the asset allocation as prescribed by the risk profile. Coming to the Quinstinct market type model, this is a proprietary model where we split the market into 6 distinct market types, with the market type 1 being the most attractive market, where the average 1-year forward return has been 56%, and the market type 6 being the least attractive market with the average 1-year forward return of minus 18%. So at this point of time, we are in a border of 4 and 5, and this is a time to hold on to equity positions, not to increase significantly, not to reduce drastically. So most of you will be familiar. What we do is that we combine this market type information along with your personal risk profile score to determine the asset allocation in your portfolio. And it is not a static asset allocation. We increase equity exposure when the market is attractive. That is a market type 1 to 3. We increase equity exposure. We maintain equity exposure in a market type 4 and 5, which is where currently the market is. And we decrease equity exposure significantly in a market type 6. Now, these are not trading calls or decisions. These are decisions which are arrived at in a rather infrequent manner based on extreme market situations. So an extremely high market is represented by a market type 6, and an extremely attractive or a low market situation, low in terms of price, is represented by a market type 1 and 2. I now invite Sanjay to revisit our earlier calls and also to take a deeper look into our earnings growth.
Right. Thank you, Sunesh. Just one other small thing that I'd like to add to that market type model, which is that market type 6 typically happens about 4% of the time when we're looking at it. So this is not something that where on a yearly basis or even every few months we're going to keep fiddling with your allocation and try and kind of change it with the market type. We're only going to do that significant reduction maybe once or twice in a 10-year period, literally, when we're looking at it, because that's how infrequently a market type 6 happens. On the other hand, market types 1, 2, 3 happen far more frequently. So one of the things that we've learned from our market type model is that typically there are more opportunities than threats, but the threats, when they happen, can make up for it in the ferocity of the downfall rather than the time of the downfall. So we've got to be equally guarded between both, and that's actually quite important. Okay, so let's look at our earlier calls. When I say earlier calls, these are basically our webinars in March and June, which many of you might have also attended. And during that time, we spoke about a few things, and we'd like to revisit those few things that we spoke about in terms of direction and see if we've got those directions right. One was that we said markets are likely to completely recover by March 2026. This direction was actually based on the market type model study itself, where we said that whenever we start from a market type 4, which is where we were in September of 2026, September of 2024, when the market hit its previous peak, if you fall by 15% within a 1-year period, you typically kind of end up recovering that entire fall 6 months from the end of that 1-year period, which meant that if you fell by up to 15% between September 2024 and September 2025, actually we fell 15% between September 2024 and Feb 2025. We said the recovery is likely to happen within 1.5 years, which is by March of 2026. We actually went past the previous peak of September 2024 in December 2025 itself. So we've crossed the peak, even though we've fallen a bit from that peak thanks to US tariff and geopolitical concerns at this point, and AI, of course, AI-driven concerns at this point in time. Second, we said that this fall is actually cyclical and not structural. What do I mean by that? I basically mean that there is nothing fundamentally wrong in the economy. It is not that suddenly people have stopped consuming and therefore growth fell off in September 2024. Growth fell off largely because 2022 and 2023, we saw extraordinary growth and there had to be some compensation happening, which is what we mean by a cyclical effect. And we said that as that normalization cycle from the previous high growth period plays out, maybe till June or September of 2025, we should start seeing a resumption of the growth trajectory upwards. And in fact, we are seeing a resumption of the growth trajectory in the September 2025 as well as the December 2025 quarterly results, which we will see shortly. Third thing that we spoke about was that based on our back of envelope calculations, the profit before taxes and extraordinary income. So here, whenever we speak about profits, we're not speaking about the traditional profit after tax. We're talking about something called profit before taxes and extraordinary income. And we do that largely so that we don't take taxation into effect. We don't take extraordinary income or expenses, extraordinary items. Let's say it's not extraordinary income, it's extraordinary items. We don't take extraordinary items like a hit on assets or something like that to kind of bias the profit growth figures this way or that way. And we've also taken out the effect of taxes largely because in 2019, the government actually reduced corporate tax rates. And this study that we've been doing of corporate profitability actually goes from 2016. So to ensure that we were comparable across periods, even though we're not presenting 2016 to 2023 data here in this presentation, we kind of figured on this profit before taxes and extraordinary items as a good representation of corporate profitability. So we said this growth would be between 10 and 14%. We are now nudging up towards 10%. So while the correctness of this direction is still loading, we seem to be there more or less. We seem to be headed in the right direction. The trend seems to be right. Finally, we said sales growth, even though there would be 1 or 2 quarters of normalization, would kind of hit about 10% for the entire financial year. First 9 months, we've hit about 9%. So again, that is still a loading direction in terms of whether it is correct or not, but we seem to be more or less headed in that direction only. So all of this is good. All of this is correct. So we seem to have got most things right. That's very good. So let's move on to the earnings study itself and see what it holds for us in terms of implications for markets. First, on the earnings study, just a quick note to tell you that this is something that we've been doing for a long time. We've been doing from the beginning of Quinstinct, in fact, from 2017-18 onwards. And what we do is that we look at the BSE 500 index, which has 500 companies which cover most of the market capitalization of the Indian markets. And what we do is we exclude certain companies which are prone to political bias, like oil marketing companies, public sector banks, things like that. We also remove companies which have not shown or which have actually shown flip-flop between loss and profit. So we want companies which are showing some profit right through, so that when you go from a loss to a profit, the growth gets exaggerated. When you go from a profit to a loss, the fall gets exaggerated. We don't want those kind of exaggerations. So typically, when you do that kind of filtering on a quarter-by-quarter basis, every quarter you end up with a sample of anywhere between 220 to 250 companies. So currently, the December quarter, our numbers that we are presenting to you is based on 226 companies across large, mid, and small cap segments. So just to summarize, we said the revival platform was going to be based on 3 or 4 things. One was that the favorable base effect, which we already spoke about. Second, on top of that, we've also had a couple of demand stimulating measures from the government in terms of GST rationalizations, as well as relief for incomes up to 12 lakhs from income tax, which happened in 2025. We also hope that the GST reductions could result in profit margins expanding because costs would be going up less than sales for companies. And the joker in the pack, which currently are not there in the December 2025 results because they've happened only in 2026, is with the US-India trade deal concluding, we first saw a reduction in the effective tariff for companies exporting to the USA from 50% to 18%. And then with the Supreme Court ruling outlawing or not outlawing, declaring the IEPA tariffs constitutionally invalid, there was a global tariff which currently is 15%. So 50 to 18 to 15. The problem is, of course, what the administration is going to come up with next. How are they going to kind of keep altering these tariffs in the future? But definitely there has been a downward momentum in tariffs, which are going to help a lot of these export companies which are exporting to the US, especially chemical companies, realize much, much better profit margins going forward. So let's look at the numbers. First, on sales. Recovery seems to be well underway with March 2024 3 showing a 12.5% sales growth. And suddenly we are almost there in December of 2025 at 11.5%. After having hit lows in September 24 of 6.8% growth and June 2025 of 6.6%. So if you look at it, September 2024 to June 2025 was the normalization period where sales and profit growth did not go anywhere. And therefore, Indian markets have been somewhat constrained in terms of returns and movement, and there's been not much momentum. But now sales has come back. It's gone up from 6.6% to 8.6% in September and 11.5% in December. And there seems to be a strong underlying demand trend. So if you look at it across market caps, the large cap companies have grown at about 13% in terms of sales. They've even surpassed their March 2023 peak. The mid cap companies have shown somewhat more muted growth at about 7%, even though directionally they've gone up from 4.5% to 7%, so that's still good. And the small cap companies have been very, very impressive, almost doubling their sales growth from 5% to almost 10% in the December, 5% in June 2025 to 10% in December 2025. So across market caps, the trend has been similar, and small and large caps have actually shown during this period in terms of the fundamental profit and sales growth. What we can see very clearly as we go across to the next slides, and I'll wait for that to kind of make that point, is that again, you see the December 2025 profit growth number, it's 12.4%, whereas sales growth is 11.5%, which basically means that costs have risen at a pace which is less than 11.5%, therefore giving a 12.4% growth in profits. This is what we call as profit margins expanding, which is always a very, very good phase for companies. When profit margins expand, even with lower sales, you can generate good profit growth. So that is a trend that we're very, very, very encouraged to see in September 2025 and December 2025. So again, when we say profits, these are what we call profit before taxes and extraordinary items. If you look at it across market caps, large caps have done very, very well with 13.2% profit growth. Mid cap has grown at about 8.3%, which is again very impressive considering that 2 quarters back they were showing negative 1.3% growth. And small caps have been the most impressive because they were showing a negative 8.7% growth and they've moved into 11.3% positive profit growth scenario. So it is not that some segments of the markets are less risky or more risky. I think this revival seems to be somewhat broad-based. Definitely in large and small caps, we're seeing significant, very, very encouraging numbers in the September and December quarter numbers. So having spoken about the opportunities that visibility in terms of growth in sales, profits are coming back, that will aid liquidity, that will support valuations, and that can kind of get the next movement upwards in India equities going after this 18-month hiatus, we must acknowledge the risk. There are a few things which are going to make markets more volatile, and we'd like to just enumerate some of these items that are top of our mind. First is what happens in late 27 or early 28 when the base effect is gone. That is still an unknown quantity. Will the demand momentum sustain? Unless the demand momentum sustains, companies are not going to invest in building fresh capacities, and the burden of investment growth will fall on the government, which has fiscal constraints. So macroeconomic growth is not likely to sustain unless the demand momentum we're able to see beyond the base effect. And that is a bit of a question mark at this point in time, which is why we preface our view by saying that we are very positive on India equity as a risk asset of choice for the next 18 months or so, maybe even the next 2 years. But beyond that, we will have to keep evaluating. We'll have to see if these 3 things that we're talking about, fresh capacities, are they going to get created? Are companies going to be investing? Second, will the external environment become more stable? We've had a lot of flip-flops on tariffs and other declarations from largely driven by the US. Will that stabilize to some extent towards the end of this year or early next year? We'll have to see. And finally, if geopolitical developments start moving commodity prices up, this positive news of profit margins expanding that we've seen in the last couple of quarters can go away. So that is also something that we will need to monitor as we are going forward. Beyond this, a few specific risks. Valuations are still high, which means that anytime there is negative news, there's likely to be very, very sharp market reactions. These sharp market reactions are likely to be short-lived, but they are there. So short-term volatility, thanks to valuations and some of the other things that we're going to talk about, still pretty much in play. But this is the cost we pay for higher returns over the long term. Sunil highlighted this as a silver lining in his part of the presentation. So it's my duty to kind of tell you that the silver lining doesn't come without a dark cloud. And the dark cloud is largely that the currency has depreciated. And while we hope that it's kind of hit a bottom and it can stabilize from here, if it doesn't stabilize or tends to kind of continue in this direction for a little more time, not likely to be for a long time, not likely to be years or whatever. But if it does kind of continue, it can test investors' patience and it can also cause significant volatility in markets. Finally, the instability in currency cause and effect both are also foreign portfolio investor flows. That's been fairly fickle. As Sunil outlined, we hope that these flows will reverse. But if the flows don't reverse, that can act as a drag on market momentum. Again, remember that in October, December of 2025, in December of 2025, market hit a new peak and foreign portfolio outflows were fairly strong during that time. So it's not that we need these outflows to abate for markets to hit new highs, but if they abate or even turn positive like they did between March and June of 2025, even as modestly as that, we could see significant market momentum getting built up. Of course, if it gets built up and markets rise far ahead of what we see as earnings growth, sustainable earnings growth, we will go into a market type 6 and there we will have to think in terms of de-risking. But currently, the opportunity is very much there, even though the risks are there and the risks seem more short-term and more related to immediate market volatilities rather than any long-term risk at this point in time. Finally, a note on gold. I think gold has not been a safe haven so far. Gold has actually been as risky an asset as equity or anything else that we can look at. Simply because equity has not gone through a 10% correction in a 2-day time span, but gold has in January, in December. And as Sunil highlighted, part of that could also be due to global interest rates rising. But part of it is also because this is a very, very perception and sentiment driven kind of asset class. And the best way that we have found to make sense of this asset class is to actually look at past returns. Past returns are an excellent predictor of future returns. So let me quickly introduce you to this. This was a study that we did on what the last 1 year does for the next 1 year. And this is a study that we've done for gold between 2015 and 2025. And I would just invite your attention to the very, very last row in that table. Whenever the last 1 year return on gold is exceeded 34%, which is about 397 1-year returns in this period, the average 1-year return going forward is just for the next year, that is just 8%, which basically means that if gold doesn't fall sharply, 32% of the time it does fall over the next 1 year. If it doesn't fall, it is likely the returns are likely to be very, very muted. Gold is likely to either fall sharply or go through an extended time correction or fall and go through an extended time correction. Either ways, when we're looking at it, when the last 1 year return in INR terms has been in excess of 70% and in USD terms has been in excess of 62%, we are not likely to see significantly high returns from gold going forward, unless gold corrects very, very sharply or it goes through an extended time correction. So gold is no longer a safe haven. And with that, what I'd like to do is pass the baton back to Sunil to just kind of summarize whatever we've gone through so far and crystallize it into views on equity, debt, and gold. Sunil, over to you.
So in terms of asset allocation, India equities remain the risk asset of choice. So we have seen a 1.5 year period of no return. There are concerns and questions about whether an aggressive diversification abroad is required. But at this point of time, based on the fact that Indian earnings is recovering and has been more predictable in the last 4 years, we maintain that India equity remains the risk asset of choice. If we see a scenario where, based on earnings growth and FII inflows start happening to the Indian market, and if we move to a market type 6, at that time, we may want to reduce aggressively the equity holdings. But at this point of time, it is a hold position. On the debt side, we are positive on the interest rates continuing to remain soft, inflation continuing to remain benign. However, we are not in favor of fresh allocation into longer maturity debt, as rates are more likely to stagnate or even harden in 2026. Important point to note here is that since debt fund taxation has been changed, we can bring in a measure of tax efficiency by investing in hybrid funds with minimal equity exposure to address the less risky portion of the portfolio. However, such exposure to be capped at 30% of non-equity bucket. When it comes to gold, a capped exposure of between 5 to 10%, depending on the risk profile, would be a prudent allocation. However, this is to be initiated in a staggered manner and possibly after a substantial decline or a time correction. We are in a position where the price movements were completely unpredictable, and there is, given the lack of fundamental measures like earnings growth, we need to approach gold also as a risky asset, probably along with equity.
This is an addendum to our webinar recording, wherein one of the risks we had highlighted of geopolitical events causing rising commodity prices, which could be one of the key risks to the opportunities in terms of better earnings growth, better macros that we had presented on 27th February, actually having come true. On 28th of February, we had the news of the US and Israel jointly launching airstrikes on Iran. And in the intervening 3 weeks, 21 days since the conflict began, it seems to have escalated and it seems to spread to the neighboring regions with attacks by Israel on Iranian oil infrastructure and Iran retaliating on oil infrastructure of Qatar and Dubai also. So markets have predictably been very, very jittery, and we felt that this presentation would not be complete without giving you a quick heads up on what are the possibilities from here on. So let's start with the market reaction first. We had highlighted in our presentation that as per our view, the Nifty had reclaimed the 26,200 mark, which it had hit in September of 2024, ahead of our March 26 schedule on January 3rd itself. However, after the news of this conflict, there has been a significant deterioration from this level. We have moved down 13%, and 9% of that has happened after the start of the US-Israel combined war on Iran. Why have markets actually fallen like this? What is the logic if one has a logic and we can kind of look at the workflow of how it goes. The main fallout of this conflict has been high oil prices, largely because of attacks on oil infrastructure, LPG infrastructure, and more importantly, the squeezing of the Strait of Hormuz as a important logistic choke point on the free transit of oil. This has basically caused oil prices to go, Brent oil, to go from the mid 60s to well past $100 as we speak. This, for a country like India, which imports a significant part of its oil requirement, is going to cause a higher current account deficit. A current account deficit is typically the deficit on the current account expressed as a percentage of nominal GDP. And current account deficit was at 0.7% of GDP last year. And this is likely to jump and exceed to 2.5% based on oil prices escalating the way that they are. So a high current account deficit may impact the currency value and cause the currency to depreciate more rapidly, which will in turn raise import costs, which will in turn also make investing into the country by foreign portfolio investors a little less attractive. The next order impact on this could also be that the higher current account deficit and a depreciating rupee can cause higher inflation, and central bank intervention to maybe protect the currency by raising interest rates, which in turn can put a squeeze on the promising September 2025 and December 2025 numbers that we saw in the main presentation of sales growth touching a high of 11.5% and profit growth touching a high of 12.4%. Now, there could be a squeeze on that. These are the main reasons why we've had such a big fall in the Nifty in such a short period of time, and markets continue to be somewhat volatile and fragile as a consequence of this. I would now like to invite Sunil to just go through what we think is the likely scenario, rather than the doomsday scenarios that currently seem to be gaining traction on social media.
We have done some preliminary analysis, especially on the current account deficit situation. Currently, we have a current account deficit which is about 0.7% of the GDP, which is really a comfortable position. And in spite of that, we have had a weakening rupee. Rupee has fallen by more than 10% against the dollar in the last 1 year. It has fallen much more against other major currencies. So rupee is at an all-time low. And what we expect is that unless the war situation escalates further and prolongs for a much longer time, we do not expect much more depreciation to the rupee because it is already underpriced. Now, current account deficit, coming back to it, from 0.7, it is unlikely to go to the 2013 levels when it had hit 4.8%, even if oil stays above $100 for the rest of the year. If it is contained within 2-3%, then the possibility of rupee depreciation being limited should help the economy and the macros to stay intact. However, in the short term, we are expecting volatility in all these fronts. Currency also is likely to be volatile. We are also mindful of second and higher order impacts flowing from the rising oil prices. For example, imports could become more expensive. There could be disruptions in exports, logistics-wise. And all that can escalate, all that can become worse if the conflict prolongs for too long. Our base case scenario is that conflict will not last too long, especially because of the impact that it will cause to the global economy and markets. However, if it does, we need to be prepared for volatile markets, and market is likely to take longer to recover back to the original level. Let's go on to the word on equity. Equity allocation. This is a good time to remind ourselves that the only way to move forward is to not look into the rear view mirror. Need to look forward to what are the possibilities and how your portfolio can be managed in order to not just defend against the current situation, to take advantage of the possible fall in the equity prices. Markets are in a fair value territory at this point of time, but there is a possibility of the economic macros, the earnings growth potential that we described in the earlier part of the presentation. That scenario has completely changed, and it can get altered significantly if the war situation prolongs. A good time to also mention that asset allocation based on risk profiling has actually helped most of our portfolios, which have fallen much lesser than the market. So asset allocation is actually a drag on returns in good times when everything goes up, when every portfolio is outperforming. Asset allocation is a drag on returns. But when things take a turn for the worse, which it eventually does, asset allocation provides a cushion and helps the portfolio fall much lesser than the market, and that is what we have seen. It's also a reminder that if you have not taken the risk profile or if your risk profile has expired, it's a time to revisit the risk profile, and that should give us some clues about how the portfolio can be managed to take advantage of the current situation. So the overall take is that equities are better positioned in comparison to much more expensive markets in the past. But we need to wait and look for signs of recovery. We should track government responses, especially how they are dealing with the energy prices as well as supplies, and follow the risk profile, follow the asset allocation model, add to equity if the risk profile allows, but only in a staggered manner, and especially when you see a resolution to the current war situation. The market type model is worth mentioning at this point of time. On the day of the webinar, we said that the market type is 5, which was an expensive market. But what the point that we made is that although the market type is 5, we are seeing a strong possibility of earnings recovery. The market type, the earnings grew in the last 2 quarters. Earnings growth trajectory improved in the last 2 quarters, and we expected that trend to continue. Now, the war has come, and that is causing a disruption. Market type model can be used as a guide to help decide allocations in the future. So please remember that at the time of maximum pessimism, the opportunity is also very high. When the perceived risk is very high, the real risk in investing is low. And rather than making gut feel or intuition based decisions, which could lead to suboptimal outcomes, we need to make decisions using the market type model and determine your allocation based on the twin factors, which is your risk profile as well as the market type model, to determine the right allocation for you into equities.
This presentation expresses the views of Quinstinct Advisory Private Limited on the date of this presentation, and these views are subject to change without notice. Quinstinct has no obligation to update the information contained herein. Furthermore, past investment performance does not guarantee future results, and the potential for profit always includes the possibility of loss. This recording is provided for educational purposes only. The information contained herein does not constitute an offer of advisory services, nor an offer to sell or a solicitation to buy any securities or financial instruments in any jurisdiction. While certain information concerning economic trends is derived from independent third-party sources believed to be reliable, Quinstinct cannot guarantee its accuracy or completeness and has not independently verified these details. This recording and its contents may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Quinstinct Advisory Private Limited.
Come to the end of this presentation, and we can open the floor for questions.
Just one quick thing before that. We've kept harping about the risk profile in this entire thing. So if you've not done your risk profile, or if your risk profile is more than a year old when you last took the questionnaire, we would request you to please take that questionnaire again. You can ask us for the link. We'll send it to you. Please take that risk profile, because that is going to be instrumental in guiding your portfolio positioning for the years ahead.